Brett, thank you for your time today. AGL's underlying profit was down about 22% in the financial year, but within the guidance range. What were some of the major factors that pushed the profit down this year?
One of the big changes that's been going on in our business is a gradual fall in price, which is now accelerating in the COVID period. So for the last year, what we saw was price starting to average down in the wholesale markets. That's been affecting our profits for the year just past. Then as we look into the coming year, what we're seeing is a greater acceleration in that price change.
You also had some issues with the Loy Yang power station as well during that year. Does this mean you need to boost your investment in reliability of some of your power generation assets?
Our asset fleet, our generation fleet is old, so you see that playing out in a significant spend every year on maintenance. We spend more than $1 billion a year, OPEX, CAPEX, on maintaining our generation fleet, particularly the coal-fired fleet. So the loss of a unit at Loy Yang for 6 months was a material effect on the past 12 months. But we've returned it to service, having spent something like $100 million repairing it, making sure that it's ready to get up and running again.
You mentioned COVID. What has COVID specifically done over the last 6 months to energy prices?
We've been talking to the market for probably a couple of years now that we were expecting headwinds to our business, headwinds to our markets, which were all about pushing price down. So good for customer, a little hard for business, but good for customer. And while we've been predicting this shift, what COVID has done is got us to the future faster. So as the virus came in, we saw it having some effect on demand, although not as much as you would think. Demand has held up reasonably well, but some softness. But it also reduced confidence in the market as well. That drove a much more rapid fall in wholesale prices on the electricity side. And then on the gas side, you've seen globally a big drop in demand, which has driven a much larger drop in price as well. So they're the most obvious effects. Separately, we've been doing a lot to support our customers. We've had something like 40,000 customers on our COVID-19 support program. Those customers are all about giving them the ability to delay payments, to get them through this difficult period till they're back on their feet again. Really pleased to say about a quarter of them have back on top of their bills entirely. The rest we're continuing to support, but that comes through in bad debt expense for us. But, you know, it means that we're looking after our customers in this tough time.
Yeah, I think you got about 38,500 on the COVID support, plus about 68,000 on the Staying Connected hardship support program. Right. But with COVID looking like it's going to be here for a while, do you expect bad debts to increase and potentially the number of customers on hardship to increase as well?
We do. So in our forecast for this year, we've allowed for another $40 million of bad debt. While that's a business expense, sitting behind that is a great deal of customer pain. So we'd much rather our customers were successful, which meant they could pay their bills, but it also meant that they weren't being absolutely hammered through COVID. I think we're in for a more difficult time. We're getting ready for that. We're putting in place lots of resources to support our customers so they get the help they need as we go through this tough time.
How would you assess your relationship with the federal government at the moment? Would you expect them to potentially intervene in the energy market going ahead if prices for some reason go up dramatically?
I think what you've seen is a government that's being thoughtful about how to get the energy market working and get the community to a lower cost position, which is exactly what manufacturing and the wider economy is going to need going forward. Price has dropped. And so that, if you like, has meant that from a government point of view too, we've got to the future faster. You might remember Minister Taylor setting a $70 target for the market. We've now absolutely blasted through the bottom of that, and we're seeing lower the prices than that today. So what the government was hoping to see on the electricity side is appearing. So now it's about getting that through to customers to support our customers in this time. The focus is now moving to gas. How do we get a sustainable gas market at a cost that works for the economy and works for suppliers?
You mentioned Minister Taylor. A few months ago we heard some reports saying he was trying to get the Liddell power station's life extended to 2026. Is there any sort of truth in that?
Minister Taylor's been really engaged with us about what we're doing with Liddell and the bigger frame about how do we get good quality, low cost power into the New South Wales market. So we've been very engaged both with him, his counterpart at the state level, Minister Keane, with the departments that sit behind them. They've spent a lot of time understanding where we're at and where we're going. We continue to engage very, very closely at all levels so that we're being right up front about what we're seeing on that site.
So is there a chance that it could be extended to 2026, Liddell?
So we've got a public program where we expect Liddell to shut between 22 and 23. So one unit closing at the beginning of 22, the rest of it closing towards the beginning of 23. Under my tenure, we've already extended that a little bit so that we're there for the summer of 22, 23, but we're reaching a point where it's a very old plant. It's 50 years old, it's worn out, the costs of maintenance are getting ever higher, and so that publicly announced plan continues. Nothing has changed in that sense, even as we keep engaging very closely with governments at all levels and their departments, supplying information as requested so that they understand what's happening, and we also talk about what happens next.
Not many companies are providing a profit guidance for FY21, but AGL is, and it looks like your profit could fall up to 31% underlying profit. Looks like it's going to be a very tough year this year for you.
It is going to be harder, and this is the headwinds that we have been talking about for the last couple of years. As price starts to fall, and we're very levered to price, we're seeing that come through in our numbers, and we're seeing that come through in lower profit. But the good news is underneath profit is cash, and cash is a much better barometer of the business. Cash flow remains very strong. The importance of cash flow is that we can therefore not just concern the market with a profit outlook that's showing a lower profit. At the same time, we've surprised the upside by putting out a special dividend for the next 2 years. We expect to pay 100% of profit out as dividend for the next 2 years. That's been well received by the market. And it's things like that, the capital management initiatives that we've put in place that show that we're a strong business that can both provide a good return for shareholders, but also we've got the firepower for new investment as it's needed in the market, as it's going to be needed in the market.
You've also set some targets for FY24, including targeting 20% of revenue from clean energy, up from about 11% today. What are some of the clean energy projects in the pipeline that you've got that are going to help you get to this level?
So firstly, we believe in a transition to a low carbon future, and we believe the drivers of that transition are around customer, technology and community. So community is manifested through government and what they're asking us to do. Technology, which is a bit like the federal government's technology roadmap. How fast is new technology going to come into place? How much does the cost of technology drop so that we can bring new technologies through? But then finally, and I think this is the most important driver, what do customers want? We're not putting a gun to anybody's head and saying you must do anything. We're responding to many of our customers saying they want low or no carbon products. We're putting them in place such that today every electricity offer we make comes with a no carbon or a carbon neutral option, and by the end of this financial year every product that we offer in the market will come with a carbon neutral option. So option is the important word here. If customers want to get to a future faster that's carbon neutral, we're here to supply that customer need based upon customer demand, and that underpins that shift from 11% to 20% of revenue being carbon neutral, because we believe customers are going to drive us there.
And also to get there, will you need to build more clean energy producing assets though?
We will. So AGL historically has been the biggest private developer of renewable energy. 10 and more years ago, we were making markets. We were the explorer, the constructor, the developer, the off-taker, the operator of large-scale wind and solar. Today there are many people that are doing that, many projects that are cropping up, so somewhat we can sit back and take the best of those projects and off-takes from them, so our balance sheet is still underpinning new build renewables. But the new role that we're looking to play more and more is the development of firming in the market. That's the thing that's really needed now. So that's your gas-fired generation, your batteries, your pumped hydro, so you'll see us particularly focused on that, both at a household level, a battery in your home, an electric vehicle out in your driveway, as well as at a grid scale level where we're continuing to announce new projects and sites, building grid scale battery and looking at pumped hydro and gas fired.
From this financial year, you're also tying executive senior management bonuses to clean energy targets, but you are still Australia's largest polluter. Is this just trying to make it appear that you are a good corporate citizen?
Not at all. This is about us responding to what our shareholders are asking for, which underneath that is what our customers and communities are asking for as well. What they want to see is a big transition. Now today, the bulk of the power that we create and the bulk of the power that powers the Australian market is thermal based. Fast forward to 2050, it's going to be dominated well and truly by firmed renewables. There is a journey and a transition to get from today to that future, and it's why you see targets in place where we start to move forward, but also targets in place that respect and understand that we will be producing thermal power for a long time to come. And at the same time, we'll be building new renewables and the firming that comes with them. So these executive targets, my targets if you like, are about then responding to those shareholders that are saying, we want to see you make progress and we want to make sure that you're focused on transition, but it's a transition that will take place over much longer than the 4 years that target shows stage one of.
And you've also got the Crib Point LNG gas import terminal as a project. If gas prices fall significantly, is that still a viable project for you?
I believe it is. I always start with, whenever I look at a new potential site or investment, I look for what do the customers need. So down in Victoria, there's a looming shortfall in gas for that market as Bass Strait runs down particularly. That market needs more gas. So Crib Point represents a way of addressing that market need. Once you've established market need, it becomes much easier to work out your business case. Over the last 5 years, I've answered many questions about what might increase or decrease the business case in the example of lower global prices. That's okay. It means we can land LNG cargoes at a lower price for our customers here in Australia. We're even more competitive. That sounds pretty good to me. That'll sound good to our customers.
Brett Redman, thank you for joining us.
Thanks, Ed. Pleasure.